Welcome back. You are watching Mutual Fund Guide. We are looking at the best funds of the last financial year. Sundaram Select Mid Cap is the second best fund in our list of funds. The fund has given a return of 10.97%, 10.97%, almost 11%, slightly behind Reliance Growth, which is at 11.29%. This is based on the NAV for the last 1 year. The reason why we have taken the 1 year performance is because last year was a great year. This year we are going into correction. Fund managers have a tough time, and what better to have the Chief Investment Officer of Sundaram Mutual, Krishna Kumar. Krishna Kumar, welcome to the show. Thanks for joining us.
My pleasure.
Let me look at the list. It's a very impressive list that we have generated on the full financial year performance. Your mid-cap fund with assets of almost about 6,500 crore has given consistently good returns, performed consistently well. Tell us what's been your investment strategy?
So, over the last 15 years, we have consistently maintained, the investment strategy. We have, tried to populate the portfolio with growth ideas, spanning all the emerging businesses, that are coming through in this country. If you look at emerging businesses, there can be needs and demands for a particular service or a particular product that gets created by changes in the regulation, changes in safety norms, governmental policies, or change in social behavior, income levels, demographics, etc. Some of these new age businesses that have kind of grown in the last couple of decades include retailing, include branded apparel, include entertainment, multiplexes. On the regulation side and safety side, if you look at emerging businesses, you had a big move in growth in the braking systems, in the emission norms, in city gas networks, etc. So a lot of these businesses have scaled high growths in the last 10 years and more. And the idea of the fund is to buy into these emerging businesses which are run by good managements. So that's been the approach.
So it's a very interesting portfolio and approach that you have. You are selecting companies which are simple, which are small, which are scalable. These 3S matters a lot, and your portfolio doesn't look like the usual portfolio that we come across different funds. The important point here is, for the benefit of the viewers, let me just add 1 or 2 points. Krishna Kumar has selected as many as 68 stocks in his basket of portfolio. He is simply diversified with 3% here, 2% here, 3% there, 1% here, 1.5% here. And if I read the names, the long list, the Ramco Cements, Sundaram Clayton, Trent, Quest Corp, Schaeffler, Arvind, Honeywell, Mahindra, NCC, Vapco Limited, SRF, Indraprastha, a whole host of companies, small companies, medium companies, they are all growing. But 68 stocks, do you think it's far too diversified, or would you think that's good enough for you to manage?
See, the main engine of the portfolio is in the the top 50 stocks, basically, which will account for about 75% of the portfolio. The rest, basically, are stocks where we are watching whether we need to kind of building conviction on them and taking to the next level, or stocks which are where we're exiting, basically. So I think the last 20 stocks would be the ones where we are basically taking call on adding to the portfolio or kind of exiting in terms of the portfolio construct. So the top 20 stocks which would account for about 40% are the ones which will also be the more core of the engine, basically. So that's how we look at the portfolio construct. We have set of stocks which are performers right now, given that they are in a smooth growth path. There are set of stocks where we are building with an eye on the future, where they would take off in terms of growth in the next 2 to 3 years. Then there are a set of stocks where we are watching and they have the potential to get into the higher end of the portfolio by getting more conviction on the growth prospects, etc. So that's how we build. So there are different buckets in the portfolio which are basically horses for the courses, and hence you find a little bit of over diversification, if you may call it so. But I think in this market where you had a very, very strong wide market participation in CY17, I thought this is the kind of portfolio that one should run with, and so the optimum number typically is around 60 stocks over a long period of time. That's how we look at the fund, and it's $1 billion fund, so we need that kind of diversification to build liquidity into the portfolio also.
Sure, diversification helps, and but there are two challenges in the current financial year, especially post the budget. We have seen correction, volatility has come in, but the expectations and aspirations from the viewers, fund investors, would have been quite high during the last calendar year. Some people would come to us and say, tell me which fund will give me 30% return. It went to that extent. How do you manage this expectation and aspirations in the current scenario?
So in this kind of environment, we are seeing a positive tailwind coming from the domestic micros, which we call the corporate earnings growth. Corporate earnings growth are rebounding very strongly, 15-20% across different sectors and aggregates. Right. And we are seeing fairly good resolution on the stress cycle. So these are the positives. So with this in mind, we do believe a 12 to 15% kind of return expectation is something that one investor should be building into, and not look at very aggressive returns which have happened in CY17. Yeah. So that's the kind of view that we are talking to people. Right. Look at long term, look at being invested during the phases of correction rather than exiting the markets.
Absolutely, don't exit. You're suggesting have patience and ride the current volatility. The one other issue which usually does not come up is that most funds also have dividend option. They continue to pay handsome. In your case also, you've been consistently paying dividends. Now, expectations, of course, dividends are not guaranteed. Again, expectations come up. People will say, okay, last year I got so much dividend, I'm not getting much dividend here. Now, that's a slightly difficult situation to manage, right? Do you face that pressure?
See, so I think fund houses have tuned their dividend policy in line with their long-term outlook on markets, equities, and their ability to keep paying out dividends, which are a function of the profits that they have in the AUM pool. So I think we have a very moderate dividend yield and policy that we promise investors. So it's not driven by any considerations other than having a very steady long-term dividend which the investors can expect basically. And that's a function of, as I mentioned, the profit pool that's available in the different schemes. So we have schemes where you have regular quarterly dividends, some where there are regular annual dividends, some where there are half-yearly dividends, and some where there are monthly dividends, which are schemes where there is a mandate which is tuned in that manner. So I think long-term policy on dividend is what dictates our dividend distribution that
right.
we're doing.
Right. So let me now come down to a couple of specifics, not specific stocks. Finance seems to be one of your favorites from what I could understand from your portfolio. In finance, there is a conflict. At one level, I say size is important for me. At another level, I say that, look, small and niche are also looking very good. So you may have some small, medium-sized finance and banking companies, but that comes in conflict with the large ones. You don't have SBI, you don't have HDFC Bank, you don't have HDFC. So the temptation to go and look at those three or that basket is also there, right?
I think our firm belief in mid-cap investing is that small is beautiful, small can go faster, and can also be aggressive. So we select businesses, within a sector or subsectors where there will be ability of these companies to move to higher growth path, within their own strengths and opportunities. So that's how we select businesses. So for example, Bajaj Finance is a large cap today, part of the Nifty. Bajaj Finserv also is part of the Nifty, but these are stocks that we held from 2008 to 2010 over a 5-6 year tenure, and when these companies were trading at market cap of less than $1 billion,
right,
and now they are probably trading at 12 to 13, 14 billion dollars market cap, right, and more. So I think the stock selection is very important when it comes to investing in mid and small caps, and so therein again the FIS approach to identification of stocks and the strengths and the business model is very important, and holding these stocks with conviction through troubled times is also very important. So you need discipline when you invest into mid caps, and stay with good quality companies through the cycle to enjoy the benefit of wealth creation.
So from what I understand is, based on the definition of the investment objective and the mid-cap nature of the fund, you have companies which scale very fast. There are companies who would move, like you gave some examples, move from mid-cap to large cap over a very short period of time. So there is more churning, let's say in 2 years' time or 3 years' time?
We actually, live through the growth cycle of the companies, invest in them when they are young, and grow along with the companies in terms of corporate earnings, and also enjoy the benefit of re-rating, which happens as more and more institutional investors discover the stock and participate as the company becomes bigger and bigger and falls into the radar. So that is how I think wealth creation happens here, and so churn ratios are pretty low. So average holding period is about 4 to 5%, 4 to 5 years, and many stocks we have also held them upwards of 10 years basically. If you have really found them pretty early in their life cycle, there are companies which we still hold from 2004-05 onwards till now, and they still are giving good returns.
All right. One last question. What will be your advice to mutual fund investors at this stage?
It's very important to assess their own risk profile, and once they understand the kind of volatility and the risks that they can take, and match that with the tenure of holding capacity that they have, I think equity mutual fund investing would be a very, very pleasant experience.
So that was the advice coming from one of the best fund managers in the industry. Thank you so much, Krishna Kumar, for joining us. That's all we have in this edition of Mutual Fund Guide. Keep watching BTVi. More news and updates coming up on the other side of the break.